All right, so here's a quick case study or a quick scenario that I came up with that is very simple and just kind of reacts to the fact that we've got a higher standard deduction right now, okay? So this might not apply necessarily to your situation, but the thought process is that now that you have a higher standard deduction, how can you take advantage of that and actually bunch up your deductions so that maybe you don't get a big deduction every year, but maybe you get a bigger deduction every other year. So at least you're getting something. You're not completely losing out. So real quick, let me go through the facts. 2019, you've got $150,000 of income, $10,000 of mortgage interest, $8,000 of state and local tax, $5,000 of charity. 2020, $160,000 of income, $9,500, $8,500, $5,000. You can see the amounts there. So the thought process is, we're here, it's January of 2019. You kind of know, you have a pretty stable employment situation. You pretty much know what you're going to be giving in charity over the next couple of years. You know what your mortgage is going to be. It's pretty predictable. So this may not be for everyone. But what I've said here is, if you do nothing and you just keep everything scheduled the way it's going to be in those amounts right there, for 2019, your taxable income will be $126,000. For 2020, your taxable income will be $136,000. And if you see here, that number, that $24,000, I didn't adjust it for the inflation. Sorry, these are old numbers, but they're still approximate. The $24,000, that's the standard deduction. All right, so that's a pretty straightforward situation. That's what your taxable income is going to look like. But let's say you take this charity number. All right, let's say that $5,000, depending on who you're giving it to, let's say you hold on to it until January of 2020. Excuse me. And you donate that $5,000 in January of 2020 in addition to the $5,000 you were already planning to donate in 2020. How does that change your situation? Well, all of a sudden you've got more itemized deductions than the $24,000 of standard. You've got $28,000. So you've got, instead of $136,000 of taxable income, you've got $132,000. You just reduce your taxable income by $4,000. So again, there's kind of a limited window to do that. If your itemized deductions are well above the standard, this isn't going to work for you. But if it's a situation where you're kind of teetering on the edge of that standard deduction, why not look at multiple years out and try to bunch those deductions? The same thing can be said for things like medical deductions. If you've got elective surgeries or things that you're able to control when, obviously if there's an accident or something, you can't control that. But if there's medical procedures or things that you can control, how much out of pocket, you can bunch those and try to get over that 10% threshold and get yourself more deductions that way as well. So just a quick thought, and this is something, obviously, if you're working with one of our partners or one of our clients, feel free to call us and we can talk you through that and start planning on that now that it's early in 2019, so that we can do something for 2019, 2020 and beyond.